Today we're going to be talking about what I coined as the term a DeFi flywheel. Now, a DeFi flywheel is very similar to a normal flywheel. It's essentially a portfolio that just keeps on growing on its own. Now, what exactly is a normal flywheel, you may ask? Well, it's essentially a system where one thing happens, which causes another thing to happen, which causes another thing to happen, and ultimately ends up right back where it started. But it consistently goes on. So in the instance of our portfolio, we might deploy capital and invest into liquidity positions, right? Which allows us to produce income. That income is then compounded, which when we compound it, it allows us to deploy more capital. Now, this is the very, very basic flywheel, just simply taking your income, putting it right back where you got it from. That's not the way to do it, in my personal opinion. And I have a way better method that I'm going to show you here today using all of this right here, basically. But the point is, your portfolio should grow on its own. It should grow sustainably, and it should have maximum growth potential. And that's what I'm going to be teaching you. So again, guys, if you find any information in this video valuable, feel free to drop a like, subscribe, and notifications turned on, and of course, let us know what videos you guys want to see next down below in the comment section. Now, I've personally been in DeFi for 4 years. I've tried the system where I just take the income and I put it right back into the position. I've tried the system where I take the income, park it in stable coins, and yield farm those stable coins. I've tried the system where I take that income and I put it directly into HODLs. I've tried the system where I try to leverage up using lending and borrowing platforms, and from what I've found, there is no perfect system, and it really depends on your strategy and even depends on the overall market circumstances. With that being said, what I'm sharing here today is what I'm currently using, and this constantly adjusts depending on the market circumstances, depending on the positions that I'm in, depending on what assets I want to acquire. So let's dive in, right? These over here on my left are going to be my liquidity positions right here. Pretty simple. These things produce income. That's one of the pros. Now, you might ask, Jake, why not just throw it all into liquidity positions? I mean, you already have stuff like ETH Render, Sol Pith, you have correlated assets, right? Well, ultimately, liquidity positions have a pro and they have a con. The pro is going to be the income that they generate. The con is going to be the opportunity cost. And ultimately, what opportunity cost is it says, hey, if you're in a liquidity position, say you start with 10,000 bucks. And then there's also, let's just say, Sarah. This is a fictionary person. Sarah has $10,000 as well. And you park, say, 50-50 in Bitcoin/Ethereum, right, in your liquidity position. And Sarah does the same exact thing, except instead of being in a liquidity position, they throw 5K into BTC and they throw 5K into ETH. So you guys both threw 5K in the assets. The difference is Sarah is holding spot. You are parking it in a liquidity position, which is earning you income, right? Well, market goes up. Maybe Sarah's 10K goes up to 15K, right? But the thing is, maybe your 10K only goes up to like 14.5K. So you have a $500 difference right there. It's not that bad, ultimately. Your goal is for those fees and that income to outweigh that $500 difference. But this happens when there's divergence. Divergence means, let's just say ETH goes up 10%, yet BTC only went up 5%. That right there is divergence, meaning that you're going to have some shift of assets. And ultimately, that's what creates that $500 difference right there. It's not really a loss, but at the same exact time, it's opportunity cost because you could have had more if you held. Now, once again, our goal is for that income, that pro, to outweigh that con. And with the right strategy, with the right flywheel, you can do so. But that's why we don't park it all in liquidity pools. Yes, we are going to beat HODL the majority of the time, but there are going to be instances where the market goes on a parabolic generational run, and ultimately, you're going to be stuck in your liquidity pools with a bunch of divergence loss, and you're just going to have to lock it in because there's nothing that you can do about it. That's going to happen in your liquidity pools, which is why we build HODL positions. Additionally, with HODL positions, we can be well diversified without having to consistently monitor things, and we have full market exposure with those assets, and we kind of just set it and forget it. Whereas with liquidity pools, we are being more active because there is some form of activeness when creating that passive income over here. And again, it's up to you on how you want to classify this income. I personally classify it as passive because I probably spend 1 hour per week or so generating income in my portfolio, right? It's not that bad whatsoever. Other people, they like to go crazy and they like to spend 3, 4, 5, 6, 7, 8, 9, 10 hours per week in their portfolio. In my opinion, that's not the way to do it. You got to look at your time adjusted return. Anyways, as I mentioned, these are my liquidity pools. These stablecoins are sidelined capital. So rather than just taking money and putting it into my bank account, I'm putting it into stablecoins because I found out that I was taking that money or a portion of it, I was putting it into my bank account, and then ultimately it was coming right back from my bank account into stablecoins, which eventually goes into HODLs or goes into Liquidity and Barn or comes back into these positions, right? So I'm like, okay, at this point, I just want to keep it in stables, not put anything in, not cash anything out. And sometimes I do do put more in on nice little dips that we see. So this is basically waiting to be deployed. We want to minimize this, but we also want to invest at good price points. The reason why I say minimize it is because the more money that we have deployed, obviously the more money that we're going to be making. So again, try to minimize that sideline capital, but again, it's good to have some for nice little dips. We also have our HODLs right over here. These HODLs are just as I mentioned, they're HODLs, right? These are set and forget, basically. That's the goal with them, at least. And ultimately, we want to get as much appreciation as possible. A lot of these assets, like Edge, for example, are assets that I expect to appreciate a ton. And ultimately, if they're going to appreciate a ton, like Edge being at a $50 million market cap or so, and I'm expecting it to go to $1 billion market cap, well, then guess what? Pairing it with Ethereum is not going to be a good idea, because whenever Edge starts to go up a ton and go on that run, I'm just going to get sold into Ethereum. That's why it's over here in the HODLs as opposed to over here in the LPs. Not everything makes sense as a liquidity pool. So once again, these are our set it and forget it. Look for long-term growth. Look for generational wealth in those ones. Our lending and borrowing. This is leverage right here. And then also it is hedging. So this is ultimately building on top of our HODLs, right? It's saying, hey, whatever assets we can, we want to put on lending and borrowing platforms, and we want to be able to leverage that capital, because it does make sense to be able to still use this capital while still having full exposure to it, right? It's almost a win-win. Because if we could have this in liquidity pools and there was no con, right? There was no this opportunity cost. That's great. Let's produce income. So the next best thing that we could do is any HODL asset that we could put on lending and borrowing platform, we can take that and we can borrow against it. We borrow stable coins like USDC, USDT. If we want to, we can also borrow like Bitcoin, Ethereum, if we're expecting one asset to outperform Bitcoin or Ethereum, basically. And we could take that crypto assets that we just borrowed and we can flywheel it right back into our LPs. Now, guys, this is what everything is. I want to dive into my actual strategy, because believe it or not, I haven't even dove into that quite yet. I've just been explaining what things are and what these sectors are. And guys, actually, if you are wanting to kind of follow along, build out your own flywheel, which we're going to dive into this a little bit later, there's a calculator that I have my developer team make right below this video. It's called our DeFi Flywheel Calculator. It's going to help you decide like your liquidity pools, where that income goes, if it goes into your HODLs, if you're cashing it out to your bank account, if you're compounding it right back into liquidity pools, and you can kind of see your income growth over time. Once again, going to dive a little bit more into that later, so stay tuned for that. So with that being said, I want to talk about where we start, right? We start this flywheel by producing income, because ultimately that's what allows this system to work. Otherwise, the flywheel does not work. We just have HODL assets, which are growing over time, or lending and borrowing assets, which are growing over time. The income is what allows us to do all these fun things, which allows us to increase our HODL exposure, leverage up on lending and borrowing platforms. It's a vehicle that opens up more opportunities, and I've even seen some of our DeFi legacy members take this flywheel and start to use it to build out traditional investment avenues like real estate, like stock investing, investing into CDs, stuff along those lines. But we're going to specifically be talking about my DeFi flywheel. So my sold to USDC income, that is coming right over here onto the lending and borrowing platforms in Sol. Now, the reason why it's going right into Sol on the lending and borrowing platforms is simply because I don't want to compound any of it into Sol to USDC, because as Sol goes up, my Sol is actually going to be sold into USDC. And right now we're in a bull market. I know there's going to be dips, and that's completely fine, but I'm looking over a longer term horizon. I'm looking over 6 to 12 months, right? And if my Sol is just getting constantly sold into USDC, it doesn't really make sense for me to take that income and park it back into the liquidity position and just to sell it for USDC again. I'd rather park it into Sol, see long-term appreciation, and then when it does get towards the end of the market and I am ready to sell, then I'll go and I'll take all my Sol and put it into liquidity pool. But more on that more towards the end of the market, guys. So again, my Sol to USDC pool is generating income in Sol and USDC because there's no incentive tokens. It's in the assets that I'm investing into, and all of that income is being shifted into Sol if it's not already in there, and it's being put up on lending and borrowing platforms in Sol token. Next off, we have Sol to Pyth. Now, next up, we have my Sol to Pyth position. Now, in my Sol to Pyth position, I actually have an interesting strategy. Remember, I'm earning about 50% Sol and 50% Pyth. Obviously, depending on trading activity, those numbers are going to vary slightly, but 50% of my income, the portion that is specifically paid out in Sol, is going right back into this position to grow it over time and produce more income over time. Because if I do compound, I will make more money over time. So it's important to not forget that, right? And then the other portion of this Sol to Pyth income is going right over here into the HODLs. And actually, for a period of time, I was able to have Pith opened on MarginFi, but then I started to have some issues with MarginFi, and I didn't really want to use it anymore, have my capital at risk, just safety precautions, and I took it out and I put it just as a HODL right over here. But ultimately, I don't have a huge bag of Pith. Assets like this, couple $1,000s in it, because the majority of it is in the liquidity pool, and ultimately, it's just on those lending and borrowing platforms to lower my loan to value ratio, make it a little bit more safe on my borrows, and once again, more on that a little bit later. So that's another 50% that's going right into Pith to increase the Pith bag over time. That way, if Pith sees a huge run, guess what? I have exposure to that. Now, next off, we have Ethereum to render. So these two are my Solana positions on the Solana network. These three are on the Ethereum network. So they're not just on Arbitrum Base, anything like that. They're actually on the Ethereum network. So they do have high gas costs, but I've already ran my gas cost analysis. I've already made sure that they actually make sense. I've entered at low gas cost times, like midnight. Right now, I'm actually recording this video at midnight to make sure that I minimize the amount of gas fees that I'm paying. Now, with that being said, we have Ethereum to render. Now, this one, for a period of time, I was doing the same thing that I was doing with Sol to Pith. Now I'm actually taking that income and I'm parking it into stablecoins. So ultimately, 100% of that income is getting sold into stablecoins. The reason why is because I already have a bunch of Ethereum exposure. I already have a bunch of render exposure over here, which once again was on a lending and borrowing platform at one point in time. And then I also have a bunch of render exposure in the position in itself. So again, I don't really have a desire to buy more render or buy more ETH. That is going into stablecoins. And ultimately, I'll talk about what's happening in those stablecoins in just a little bit. And one thing I just want to go ahead and give you a teaser on is that I don't want to accumulate render, not because I don't believe in the asset, but rather because there's better alternatives like Aether or Desync, in my personal opinion. Therefore, meaning that I want to accumulate those assets. So they're being parked into stablecoins, which will eventually go to buy those assets. But let's dive into this Desync one. This Desync one, I am taking all that income and I am putting it into stablecoins. Once again, same exact thing. And ultimately, sometimes some of this income is staying in Desync, whereas other times I'm using those stablecoins to actually buy up Desync. And I just opened this position, so I don't really have much Desync, only a couple $100, so I don't have it included over here on HODLs. But ultimately, I do want to build a position in it, which is why I have this position over here to produce high income, and I take that income, build an actual HODL position. And then over here, we have Ethereum to Ondo. This one's pretty correlated, but I want to use this one to essentially build up my bag in Ondo because I don't have that big of a bag in Ondo whatsoever. I have maybe $500 to $1,000 or so that I bought a while back, but the majority of this is going to come straight into the HODLs, and I'm just going to shift the Ethereum portion right into Ondo. And again, I just opened up this position literally 30 minutes ago, so I'm mapping out what I plan on doing with this position. And I was actually doing something similar with Ethereum to Aether for a period of time. If you guys were watching my videos for the past couple months, basically I was using the Ethereum to Aether position to build my bag in Aether. Now I have like $4,000 in Aether. I was able to take another $4,000 in overall profit as well. So that's $4,000 of free Aether and then $4,000 in profit, and then also keep the initial amount that I put in the position. Pretty awesome. That's the beauty of DeFi liquidity pools. Anyways, now that we broke down what's happening to my income, we need to talk about what's happening to these stablecoins because this is just sitting here. As mentioned, right? I am looking for good opportunities in the market. So either these stablecoins are going to be used to get me back in balance. And when I say back in balance, I mean typically I want to have about 40 to 45% invested into these LPs. And then I want to have about 55% or so, sometimes 60% over here in these HODLs as well as lending and borrowing platforms, basically. That's my allocation because these have that long-term growth potential. These ones have like 5-10x potential, whereas these ones over here are going to have less growth potential. They're going to be more correlated. And of course, if they do have growth potential, they could witness divergence loss. So I'm using those LPs to build up those HODL bags and once again, keep it in check. So if eventually I'm compounding so much into my HODLs and my lending and borrowing portfolio to the point where, guess what? This is now 65%. Well, I need to start to take those stablecoins and I need to start to put them right back into the liquidity pools, basically. Whereas let's just say my liquidity pools have grown a lot, right? Or maybe I'm just looking for good opportunities in the market. Maybe that's buying up more Aether. Maybe that's buying up some Desync, right? Ultimately, I'm going to take that and put it right into the lending and borrowing platforms over here, just like we talked about with liquidity pools. Now, that being said, let's talk about what's actually happening on the lending and borrowing platforms now that we know what's happening with these stablecoins. And I'm just going to map it like this. So again, we're putting these assets up ideally in the same place as collateral, and then we are borrowing USDC. So we borrow USDC, sometimes we'll borrow USDT, really any stablecoin that has a reasonable interest rate. And ultimately, once we borrow that USDC, this borrow is going to remain fixed. Obviously, we're going to pay interest, but this remains fixed. So ultimately, what that allows us to do is take that USDC and instantly park it into assets that are on these lending and borrowing platforms. So we could put it back right over over here, or we can park it into HODLs, or we can park it into liquidity pools. It really depends on what the current market circumstances. But since that USDC remains fixed and all of these other ones we're expecting to appreciate over time, well, if say we borrow $10,000 and then all of a sudden we shift it into, like, let's just say some SOL, and then that $10,000 in SOL appreciates to $12,000 in SOL, well, ideally our borrow is still $10,000. Maybe it's $10,050 because we have some interest, right? But we keep that $2,000 profit, we pay back the $10,000, and we are able to profit $2,000 by not putting up any more capital. So we're leveraging. And then occasionally there is the hedging, which I'm not going to really talk about in today's video. So if you guys want to hear more about that, make sure to drop a like and subscribe, notifications turned on. But yeah, this is the overall Flywheel strategy. We use the lending and borrowings for the leverage, we use the HODLs for long-term growth potential, and we use these ones for income. Three crucial elements of a portfolio in my personal opinion. Now, with that being said, I want to talk about how you can build this out for yourself. And again, if you guys want me to dive fully into this, make sure to let me know because I'm probably going to be making a full video on this. And this is the first time that I'm talking about this calculator on the channel because it just got finished. We did post it internally for some members to check out. And there is a short little video that explains how to use it if you guys want to go in depth in that. It's just builderwealth.com/flywheel. Once again, it will be down below in the description. You enter your initial capital. So in my example, I probably have about $150,000 or so right now. We enter the APR that we're doing across our LP portfolio. So right now I'm currently averaging out to about 10% per month. We estimate our average monthly appreciation, which I'm personally estimating about 2% a month. One important thing to mention is this compounds. So if you say have $10,000, that goes up 2%, you're going to now have $10,200 next month. And then your $10,200 is going to appreciate by 2%, as opposed to just saying, hey, over the course of, a year, it appreciates 24%. It compounds. Do keep that in mind. And then our divergence loss profit margin. If you don't know what this is, keep it at 100%. Whereas if you do know what this is basically taking your versus HODL number on your LP portfolio and dividing it by your overall earnings. Now, I'm typically at 85% profit margin on my income, which is great. And then we look over here on my initial capital allocation. Once again, I want to have about 55% over here and about 45% over here. So just like that, we adjust those numbers. Then we talk about what happens to this income. So this is going to help you do it from an overall portfolio level on a very, very broad spectrum. Again, in our legacy program, this is something that we dive deep into, like where exactly we're allocating the income. We do exactly what I just did right over here, help determine the best way to essentially build out a flywheel to maximize your growth, maximize your income, stuff like that. And it's all about balance at the end of the day. We even have some members that like to cash out. So again, I'm not really cashing out anything. About 65% of my income is going into those HODLs, whereas the other 35% or so is going into those LPs. Now, again, there are going to be instances where it goes into stablecoins, and those stablecoins will eventually get put back into liquidity pools. But most of the time, the stablecoins are held for a couple days. There's a market dip, and then I buy up HODL assets. So now that we've inputted all of our different parameters, we can look at our portfolio growth over time, our monthly income, and even our flywheel map. So if we take a look at the flywheel map first, before we get into the fun stuff, you'll notice that liquidity pools are generating a 120% APR, which is obviously income being created. Of that, 35% is actually compounded right back into liquidity pools, which allows you to produce more income. That's that flywheel that I was talking about, right? Liquidity pools produce income, which allows us to compound and deploy more capital into liquidity pools and produce more income, right? And just consistently repeat over a longer horizon. But with that being said, we're also taking some of that income and branching it off. We have 65% going into HODLs. And again, when I say HODLs in this instance, I'm talking about amongst lending and borrowing platforms and actual HODLs, because I do consider stuff on lending and borrowing platforms HODLs. It's just like, if we can, we're going to leverage it. If not, it's all good. And then 0% is being cashed out. So we could see that from a glance by using this little calculator right over here. The next thing that I want to show you that is absolutely crucial is your portfolio growth over time. So you can see I started with $150,000, and about $67,500 is in my LP portfolio, and $82,500 is in my HODL portfolio. Now, over time, you could see month one, I now have $158,000. Obviously, that's assuming that we see no depreciation. This is just kind of like you start here, you end here type calculator, because obviously there's not always going to be consistent appreciation, but we could see that portfolio grow over time. Month two, $167,000. If we go all the way to month 12, we're at $291,000. That's because number one, we had monthly appreciation. Number two, we have income being generated, and it is assuming that you're paying down your divergence loss, and then that income is being used to build our portfolio. Guys, if we were to cash out all of our income, like a lot of people are doing, let me show you what that looks like. right? At the end of the year, we end up with $267,000. 77 grand has been cashed out, but ultimately our portfolio does not see as exponential growth. So we want to make sure that we are compounding that if we can, or we can afford to. And we can even have a strategy where maybe we do want to narrow that down to 50%, and then we want to cash out another 15%. Then after 12 months, we've cashed out nearly $14,000. It's a little over $1,000 a month, which is great supplemental income. And then the other thing I want to show you is your monthly income. It's going to show you, so you start off making roughly $67.50 per month off of this $150,000, because remember, you only have a portion allocated to those LPs. And then from there, over time, you could see by month 12, you're now making nearly double that at $11,500. And this is your total income. Once we look at after divergence loss, you'll notice that that's about $10,000 still, which is great. That's on a monthly basis. So again, this is exactly what creating your own DeFi flywheel is all about. Your portfolio should grow on its own. If you guys want to access this resource, it's right below this video. I hope you guys found this video informative. If you guys want me to make more content like this where I just spit value, no strings attached, once again, let me know. I'm happy to do so. And I'll see you guys in the next one. Peace out.